Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosier.
Welcome, Pacesetters of Agribusiness, to another episode of the Pacesetter Pod, where we amplify voices from across the agricultural industry. We aggregate those perspectives and work to elevate our collective thinking around strategy execution. I'm your host, Joe Mosier, and I appreciate you tuning in today. In the past on this show, we have talked a lot about the dual mandate of agribusiness leadership, the tension between preserving value, the business that we have now and we've had in the past, with creating value. What kind of innovations and growth we need to create value in the future. The preserve versus create tension. That's the dual mandate. Now, this has always been an intellectual and a leadership challenge. It has always been difficult to mobilize an organization around that multi-directional plan of action, things that are preserving and creating value simultaneously. And it's been difficult because oftentimes these objectives are in competition with one another, if not outright conflict. Now, this shows up across agribusinesses and everyone that we work with. That tension is there, and I'm fairly certain it exists in businesses writ large. But what I do know is within agribusinesses, that tension, the pressure of that dual mandate shows up acutely strongly within cooperatives, just given their ownership structure and the folks that you're accountable to. Now, as we sit here in the first part of 2026, a very high number of co-ops across the country have reported local losses for the last fiscal year, and that creates a lot of pressure when the patronage is reduced to a farming community, a membership base that's already struggling to break even. They've been relying on their balance sheets to get through the last couple of years, and that balance sheet erosion is starting to get more and more tense. Yes, there's some organizations that have printed great results, and they've got the patronage headlines to celebrate, but that was by no means the standard as we look over the last year. And some pretty familiar ways this shows up, right? You'll hear things like, my patronage check feels smaller than in years past. Well, it is. But then simultaneously, well, why are we investing in a new agronomy facility? Why do I see new feed trailers? Why are we buying additional fleet vehicles and rolling stock? Whatever it might be. And the tension is very simply put. You know, your members built the cooperative and they deserve to benefit from it. No doubt, unquestionable. At the same time, if you only reward today, you may not have a cooperative worth belonging to tomorrow. So it sets up this kind of binary A or B scenario where you need to make decisions around capital and investment and distribution of value today versus tomorrow. Now, we recently had Carl Dickinson on the show. And if you missed that one, I encourage you to go back to episode 158 to listen in. Carl was the longtime, now retired, CEO of Central Valley Ag in York, Nebraska. Now, Carl was pretty clear in his conviction after a long career that you can have it all. You can do both. You can reward members today and you can build for the future tomorrow. And I agree. This is not a financial puzzle, right? This is not a head scratcher that you sort of hammer out with a calculator and a bunch of time sitting in a quiet room just thinking it through, trying to find the glide path through the tension. No, this is a leadership and culture puzzle, and your ability to shift and navigate an organization through this tension, because both things are true. Both things must be true. And in times like this, where co-op management, boards of directors, and members are under such stress, I think it's really important that we talk about these issues. So even if we've talked about this binary construct in the past, even if you feel like you've heard it all before, I think in times like this, it's particularly important because the failure mode, the temptation to over-index on going whole hog in the future and ignoring the member needs today can be catastrophic. And similarly, saying we're going to fully focus on helping grower profitability and do everything we can to the detriment of our future to support our growers today can result in an extinction level event. So there might be limited appetite right now to pan back and widen the lens of consideration and think about this when times are tough. But if we don't think about it now, there's going to be even less appetite to dig in and talk about this stuff, talk about the challenges of investment and governance when times are really good, because when times are good, suddenly you don't have that pressure anymore. So it's right now when we're feeling that tension, we need to talk about this and get our thinking clear around what it is we're confronting and what we can do about it. So that's what we're going to do. This week and next week, we're going to spend some time talking about the challenges with capital allocation and member-owned co-ops. And I want to tackle it through two different lenses. The first is the investing for today versus tomorrow challenge, which I've kind of already teed up. And then I want to talk about the counter-cyclical nature of investing, right? Going big when things look bleak. Now, these two are very closely related, today versus tomorrow and counter-cyclical investing. So, they're so closely related that distinguishing between the two of them is a bit of a false construct, I'll admit that. But trying to tackle all of this in one episode would be incredibly dense. It'd be really lengthy. And so we're going to try to break it into two to give it a little more bite-sized appeal. So this week, we're going to talk about today versus tomorrow. And next week, I hope you'll tune in, where we're going to tackle counter-cyclical investing. Before we do that, thank you as always for tuning in today. A quick reminder to like and subscribe to the show wherever you get your podcasts. And please consider leaving us a review so that we know how we're doing, what we're doing well that you want to hear more of, what you want to hear less of, the kinds of guests that you want to hear from, the kind of topics you want us to dig into. Leaving a review is the best way to help us get better. It's the best way to support the program, and it doesn't cost you a thing. Now let's roll. We're going to cover some familiar ground here, but I want to talk for just a moment about why the tension exists, even though I know it's pretty obvious. But I want to create a common foundation for us to operate from. Cooperatives are structurally unique, right? They're member-owned, they're democratically governed, and they're expected to return value now through patronage while also building equity for the future, right? And it's that member ownership and that direct voting rights that really changes the structure for co-ops compared to their privately held competitors. Now, as the co-ops have gotten bigger and more complex, which the overwhelming majority, not all, but the overwhelming majority of co-ops that are still around, those that have endured over the last decades of consolidation, they almost certainly are bigger. They almost certainly are complex. I don't think there's anything that insulates you from complexity in this market anymore. And in that context, as you got bigger and more complex, the value now versus value later challenge becomes amplified, right? Successful years where you're, flush with cash, where you can rebuild your balance sheet, you can distribute cash to your members, that only temporarily relieves the pressure, right? It doesn't actually solve the problem. It's going to be there, yes or yes. And on a multi-year basis, the size and scale of the organization doesn't resolve that underlying challenge. Now, multi-line co-ops that don't have a processing anchor, think like a wet corn mill or a crush plant or biofuel processing, refining, something like that. Multi-line co-ops without that processing anchor, they don't have a single high-margin business unit carrying the load. And their margin has to be assembled across agronomy and energy and feed and grain. And yes, agronomy has been the growth engine for the last number of years, but these things are cyclical, and eventually that does shift. So as you're assembling that margin across multiple business units, it often means, now you're trying to meet this two-folded challenge of today versus tomorrow, all from a pretty constrained margin pool, which further, again, it's a challenge unto itself, today versus tomorrow. It's a bigger challenge when you're a co-op and you're accountable to your ownership, who vote with their bushels and actually vote with their votes on an annual basis. As you get bigger and more complex, it becomes more challenging. And as you're trying to do margin assembly across multiple business units from a constrained pool, it really makes it more and more difficult. And so that patronage promise to your owners, which has historically been a real strength and differentiator, it's also a constraint in terms of the long-term outlook for the organization because members expect it. Lenders are watching for it. And while all those things are signals of success as you're distributing capital, retained earnings are the primary equity building tool. So this is why it feels like it's a trade-off. Do we distribute patronage? Do we retain equity to build the balance sheet? Take a feed milling example, right? You've got this business that's very capital intensive. In these diversified co-ops, it's often underappreciated by the members who don't use it. They see all the capital flowing to it, but I don't have any cattle. I don't feed chickens or pigs. I don't need it. So it creates tension among membership, but it's strategically critical for diversification and margin stability. And so that kind of, again, I'm trying to paint the picture here, this tension that emerges. Now, through all this, it's actually the service culture that's the connective tissue. Members will tolerate investments for the future that they may not be around for, or investments in businesses they don't participate in. They will tolerate that when they feel the quality of service for however they're transacting with the co-op. But when that service slips, every dollar retained becomes a grievance, further amplifying the challenge. And so I just wanted to kind of level set there around why we talk about this so much within co-ops, what makes them different, and why it's worth sort of digging into today. So if we're always trying to look at this a balance between today and tomorrow, again, my friend Carl Dickinson would say that you don't need to choose, you can have it all. And I think he's right over a certain period of time. But over the shorter terms, it does feel like strict trade-offs. What is the right balance? And what happens if you get that balance wrong? Some examples here. If you over-index on distribution of capital on an annual basis, if you're really focused on patronage, one of the logical conclusions of that will be a cash-strapped balance sheet. Taken to its extreme, you might even find you have aging infrastructure. You might find that you have an inability to compete on technology or talent if you're so capital constrained. And eventually, again, taken to the extreme, this could result in losing relevance to the next generation of growers, which is catastrophic in the kind of generational shifts that were happening right now. But on the flip side, over-indexing on retention of earnings and reinvestment of those earnings into the business, you're risking member disengagement. They start to take their agronomy business and their bushels, even their energy and their feed demand, start taking it elsewhere. Right? That member disengagement flows directly through to bottom line results. You start to see more board turnover. Either people can't survive transition of terms because of that disengagement in the community, or frankly, they don't want to be a part of it anymore. You start to see that competitive vulnerability as members are routing their business elsewhere because they're saying, if I can't capture immediate value with this co-op, well, I'm going to start taking a better basis down the road. I'm going to take slightly better pricing on my dry fertilizer and my inputs from somebody else. It's going to be a loyalty erosion. So this is where you really got to be careful that you don't over-index in either direction. We also have this demographic trap that I think is really worth considering. Legacy members, again, who built the co-op want their reward now. Younger, growth-oriented members tend to want a co-op that can compete in 2035, right? Both of them are right. Ignoring either is dangerous. I don't think it's true that younger farmers don't care about patronage. I think they don't care about patronage yet. We've talked about that in some previous episodes. But what do you do about this? You got to watch the signals to see if you're starting to over-index one direction or the other.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
And here's a real-life example signal to watch. When your best agronomists start leaving for retail competitors, or when you start to see a neighboring co-op is out investing you in precision ag, for example, those are the kinds of lagging indicators that suggest the balance has tipped too far. You maybe have started to do things that are to the detriment of talent and their opportunities, their ability to compete now, or perhaps you're starting to signal that they're best incented to build relationships with others for the future. So then it comes down to, I could give you lots of examples. I don't think you guys actually need examples. I think you feel this every day. I'm hoping this all resonates and feels not just familiar, but factual. So I'm not going to, pepper you with additional examples. But if we think you can actually have it all, if we think this either or decision construct is faulty, what can we actually do to kind of help navigate through it? Because saying it just takes good leadership, I think, is a bit of a cop-out. We need to put some meat on the bones here. So I've got some ideas here, and I'm just going to throw these out. And I think the through line that I really want to drive home is you need to think creatively. You need to get together as a group and say, a group being primarily initially the executive team of your co-op, but then eventually your board of directors as well, involving them, and saying, what can we do? If we're feeling this acute tension and we're disappointing some and disengaging others, how are we going to strike the right balance? So the first thing that I would suggest or just kind of throw out there to kind of get the wheels turning is, have you revisited your patronage structures? Could a tiered or qualified patronage structure actually change the dynamics a bit? Are you rewarding volume and loyalty while allowing the the board to flex that cash versus equity patronage based on capital needs. Maybe a simple way of putting that is your cash and carry customers. If you've got full service customers, we talked about strategy tax here a couple weeks ago in the podcast. If you got full service members that are the primary thrust of your business and maybe the primary profile growers in your area, but you got these cash and carry members as well, it's maybe unpopular, uncomfortable, but it's a fair question to ask. Should cash and carry, which is just a back-to-back volume business with no value-added services, is that eligible for patronage? Yes or no? Is that a qualifying purchase? Or is it a qualifying purchase at the same ratio as a full-line service purchase? There's some ways you can look at changing the incentive structures to help you strike the right balance. Greater patronage payments maybe as a greater share of volume with a grower. There's a multiplier on your patronage when we get X% of your agronomy business and X% of your fuel business and X% of your grain, your bushels, or share of wallet. I think revisiting your patronage structures is worth looking at, because patronage is, of course, one of the main ends of the spectrum here that we're trying to negotiate around. Perhaps less contentious and not as common as I'd like to see is just building some transparent capital plans, right? Every management team and every board ought to have a 3 to 5 year investment roadmap. Now, years 1, 2 are probably pretty crisp in terms of here's exactly what we're going to build, here's what it is, here's what's going to cost. Year 3 is maybe a forecast, maybe year 3 and 4 is a forecast. Year 5 is simply a loose projection, right? So the further out you get, the less crystallization of the details, the fuzzier the resolution is, the further out. But bring a 3 to 5 year investment roadmap to membership. I think, and I've seen that members can support investment, long-term investment, when they can see it and understand it. And going back to last week's episode around the strategy recitation challenge, also go back and check out episode 163 if you missed that. When you can actually talk about that transparent capital plan in the context of the strategy you're trying to deploy, it's pretty powerful. And it'll remove, if you forecasted your capital plans, it removes surprises, which is a huge accelerator because surprises create distrust. If people are just saying, man, I just heard that we're building this new facility, at the same time that they find out what their patronage check is, they're looking at those two things as that was an either or choice, right? They took this money from here and put it over here. And I like that or I don't like that. My neighbor likes it or they don't like it. Dad likes it or he doesn't like it. But when you have forecasted the plan over multiple years, anchored it in the strategy, signaled that this is going to happen, suddenly it's part of the overall portfolio of ways that you've distributed or allocated capital to meet both the needs today and tomorrow. Try your best. Another tactic is to align member behavior with co-op performance. Now, this is similar to that patronage structure, but we had a lot of conversations the last couple of years about asset closures with our co-op clients. Which assets should we close? What's the benefit of doing it? Is it a one-time benefit? What do we put at risk? Do we get those bushels? If we close this elevator, do we get those bushels elsewhere? Do we lose agronomy business in the process? For any of our clients that are listening, you think I'm talking about them? I am. I'm also talking about a number of others, so you're not alone. But I think if you can show membership for a given asset, what's required from a volume standpoint for the co-op to meet the performance thresholds, for the volume you put through the asset to cover the costs of operating it, that's an important way to sort of establish the expectation with members. I don't think at the end of the day, if people are really honest with themselves, they don't want, profoundly successful locations subsidizing other locations that can't cover their fixed costs. Because while that's a convenient place to deliver grain for those local farmers, it's actually eroding the sustainability, the long-term sustainability, and the economic profitability of the co-ops over that same long term. Members don't just vote for directors and vote for mergers. They vote with their bushels. They vote with their input purchases. They vote with where they get their fuel and their feed from. You need to listen to these votes, of course. But those votes also need to understand the secondary impacts that their votes have. When they choose to take their bushels elsewhere to capture 5-cent basis, a better basis, that's going to have some knock-on effects. That has implications. And so while I think management has the uncomfortable but necessary obligation to identify locations that ought to be closed, economically speaking, And boards have the obligation to consider that and weigh that and make a decision based on the long-term prosperity of the co-op. The members own that decision too. Because unless you have gross incompetence amongst your management teams and your board, which I have yet to see gross incompetence at that level, unless you have that, members have also contributed to that situation by redirecting their business elsewhere. Another idea here, still just spitballing, but you could use service culture as the permission structure to invest. Now, what do I mean by that? Again, when members feel the service, when they feel they're getting a relationship with their agronomist that they trust and value, that they're getting value from, when they feel and experience reliable energy delivery, when they feel and experience a responsive feed mill that tops them off before the big snowstorm comes through, that addresses a quality issue, that shifts production around to accommodate them for a last-minute order, whatever it might be, when they feel that kind of service, they tend to grant the board and management more latitude to reinvest. Service culture is the permission structure to invest in the future. Service is what makes retention of equity on the balance sheet and reinvestment into the business feel fair. If you think I'm wrong, I'd love to talk to you about it. I'd love to have you on the show and we can chop it up. And then there's some more tactical things you can do. You can benchmark your equity position. This happens in the boardrooms, right? We compare equity to asset ratios. We compare per member retained equity to peer co-ops. We use that data to anchor board decisions and board conversations around the right balance. And I wonder, you don't necessarily want to maybe disclose precisely where you're at. I don't know. But if you've made decisions around distribution versus reinvestment based on peer comps, perhaps that's something you can share with membership. Perhaps that's part of the talking points. Perhaps you say we're within the normal distributive range of how other similar co-ops are operating. Because sometimes we hear these anecdotes. So-and-so down the road pays this for that particular service. They don't have to pay for a toolbar. Or that elevator is open until 8 p.m. all the way through end of January. Even on Saturdays, they're open 8 to noon, whatever it might be. You get this anecdotal evidence that comes through, and sometimes it's true, sometimes it's not. It always gets amplified and magnified, and you're responding to that. And that's okay. You should respond to the feedback from members. But you can also share some of the quantitative analysis that you've done to say, we've looked and we think our actual storage fees are right in balance with others. And mind you, this is what's necessary for us to cover our fixed costs. We don't want to be a co-op that subsidizes underperforming assets, and so on and so on. So I think to kind of bring this all home, this is it. It's not truly a financial puzzle. I agree with Carl Dickinson. You can have it all, but it's a leadership and culture and communications challenge. Now, the rough news is the tension's never going to fully resolve. The goal isn't to solve it. The goal is to manage it well together every year. And when you use service culture as a permission structure, when you help create shared ownership around economic outcomes with your membership, when you forecast the plan, what you're looking to reinvest, what you intend to reinvest, what you intend to distribute in terms of patronage, when you've done all that, and when you've also anchored it in, here's what we're trying to do by reciting your strategy, you will be in a better position every year to, depending on the entirety of your balance sheet and your earnings available, to quote unquote have it all. And so I encourage you to, as obvious or maybe as sort of persistent or familiar this challenge feels, don't take it for granted. There are ways to do it better. And for those of you out there that have a touch on additional mechanisms that have really helped you set apart and you want to talk about it, please reach out. I'd love to hear from you. Thank you as always for tuning in today. I appreciate you as always being part of the Pacesetter Pod community, taking the time to listen, taking the time to consider different ways of tackling these problems, and ultimately, to the extent that it's applicable, actioning these ways to improve strategy execution, all in support of growing your own agribusiness. That's why we're here. That's what we're trying to do. And I love that you're a part of it. Thanks again for joining today. I look forward to having you join us next time right here on the Pacesetter Pod.
This is the podcastfactory.com.